What's up everyone, it's Karthik with MoneyVest. So inflation numbers came out earlier today, and I also did close out my Tesla calls. So the ones that I sold yesterday, I ended up closing them out today. It was actually one of the most lucky trades that actually ended up working out really well, pocketing just over $1,000 in less than 24 hours. So I'll break down exactly what that trade was and how crazy it ended up being. As always, make sure that you drop a like and subscribe to the channel if you haven't already. Got lots to unpack because we did have inflation numbers come out earlier today at 8:30 a.m. Eastern. Of course, I was live to cover those numbers. And tomorrow, we've also got the PPI numbers as well as a Jerome Powell speech at 3 p.m. Eastern as well. So markets were basically flat. We had the S&P 500 pretty much not going anywhere. The Dow Jones also very, very flat. And the NASDAQ was slightly lower, 26 basis points. And I mentioned yesterday that I have gone crazy. I have literally gone crazy. I've sold 2 covered calls on Tesla all the way up to $700 strikes expiring in December 2026. And that was during market open hours when Tesla was kind of bouncing higher. And well, guess what? Tesla dropped 6% yesterday, and I showed you guys the option contract and how it was priced. I was up over $1,600. So this right here was the option contract after yesterday's sale, basically selling 2 covered calls, and was up almost $1,600. You can see the change since purchase, up 16%. Well, guess what? Today, Tesla gapped up a little bit. It was up over 2.5%, I think over 3% after inflation numbers came out. And I got a little bit of some pushback in the community in Discord for selling calls on my long-term shares. And you know what? I gotta admit, sometimes I do get carried away on the emotional side of things because the premiums were just so juicy. I was like, 10 grand, one trade, you get to keep the entire premium. And I gotta admit, I was kind of taken away from the premium itself. But, these were long-term shares for me anyway. I really don't want to risk them, regardless of how far out or up I'm going in these strikes. Like $700, I would still be, doubling my position from $350 to $700. That's a 100% gain, plus keeping the $10,000. But I was like, you know what? These are long-term shares. You never know what Tesla could be, worth, let's say 5 years from now or 7 years from now. Why gamble on those long-term positions? So I was able to pocket in just over $1,000, and this is where the crazy luck comes in, because as soon as the markets open, I ended up buying these contracts back. So I closed these calls exactly at 9:30 a.m. Eastern. As soon as the markets opened here, I closed these out for $42.62. You can see the details here. So the alert details: Tesla, December 18, 2026, $700 calls, bought back. This was an order filled at $42.60. So I received $47.90. So that's how much I received in credit per contract. And I ended up paying $42.62 for buying to close. So I'm pocketing the difference, which was $5.28 per contract, right? And that was overnight because I sold them yesterday. I closed them this morning, and that was just over $1,000 because I sold 2 contracts. Every contract is 100 shares. So $5.28 times 200, and you get to just over $1,000 in less than 24 hours. And then, of course, Tesla shot up during the day. It was up actually at one point up over 4% after pulling back a little bit after the market opened. And then, of course, we pretty much closed out flat. So all in all, everything said and done, just made over $1,000 on this option trade. Not too shabby, but I really, the lesson learned here is, if you've got your long-term shares, for me personally, the lesson is don't gamble on them, right? Because Tesla could have very well rallied today or tomorrow in the coming weeks, and that would have been fine. Like, that would have still been fine. But when you're gambling with your long-term shares, the problem then becomes, you've got your capped upside. Even if that is a crazy upside that you've capped at, like for me personally, my upside was capped beyond $748 because 48 or 47.90 basically was the premium received. And you take the strike price, which is in this case $700, plus the premium received, that is your capital gain that is going to be capped at that price. So for me, that was $747.90, 2 years out, and beyond that, I would not be participating in any of that momentum. Now, of course, granted, Tesla 2xing from here is very unlikely, especially in the short to medium term, but the lesson is long-term shares, and I got that on our checklist on our options trading PDF as well, that if you've got a long-term position, don't trade options on those, simply trade options on the ones that you meant to trade options on, right? So there's going to be a distinction made between your long-term positions and your options positions. So for me, didn't want to do that anymore. So just, took the $1,000, ran with it, and we are done. By the way, if you want to get access to all the trade alerts and find out exactly what crazy stuff I'm up to, link's going to be down below. We've got a 16% annual discount that allows you to save for 2 free months, and that will give you access to the MoneyVest website, the Discord channels, weekly updates on the options portfolio, all the trade alerts, engage with thousands of traders, investors globally on our Discord, and of course, you can also access all the 4 courses. You can take a look at the course curriculum over here if you want to join for that as well. That's going to be the MoneyVest education tier. And that is pretty much all access, gives you access to pretty much everything. Courses, website, trade alerts, Discord, members only videos, Patreon, everything. So links going to be down below. We'd love to have you on board. Take advantage of it. Now, inflation numbers came out earlier today, as I broke down, in my previous live stream. So if you come over to market calendar, economic calendar here, if you remove for low and medium impact items, these were the numbers. We got inflation rate month over month at 0.2%. That was exactly what was expected from the market. Year over year, which is headline CPI, we're sitting at 2.6%, and that was exactly what was expected as well. Core inflation, which is when you strip out for food and energy, we're sitting at 3.3%. Expectations were for 3.3% also, and core CPI month over month, expectations were 0.3%, and we came in exactly 0.3%. So all in all, on all 4 accounts, inflation numbers came on par with expectations. We weren't higher, we weren't lower. We were exactly what the expectations were. And so before the numbers came out, the markets were kind of on the fence that whether we're going to see a rate cut or not. We were like 58-42 for a rate cut, in favor of the rate cut. And since after these numbers came out, it is now pretty certain that we're going to get a rate cut, 82% probability that we're going to get a rate cut in December. The next meeting is in about 35 days. Rate cut of 25 basis points going to put us down to 4.25% and 4.5% for the federal funds target interest rates. Now, this is still going to be subject to the next few reports that we get, because the meeting's not until December 18th, and we still have one more unemployment and one more inflation print to come out prior to the next meeting from the Federal Reserve. And we're also going to get the summary of economic projections. And tomorrow, we've also got the PPI numbers. So PPI numbers are just as important as the CPI numbers, and we've also got the Jerome Powell speech coming up tomorrow at 3 p.m. Eastern as well. So all in all, markets are still very optimistic of the potential for one more rate cut in 2024 of 25 basis points. Now, inflation is still pretty elevated. Now, if I go over to specifics of that report and show you guys exactly what happened, shelter prices still up 0.4% month over month, year over year sitting at 4.9. And most of that disinflation that we're seeing is coming from one item and one item alone, and that is energy. If you haven't guessed it already, it is oil prices tumbling down, which are obviously helping overall inflation. If you take a look at energy here, just look at the deflation that we've seen, right? This is what deflation looks like, because this is when prices are indeed going down on a year-over-year basis. This is what the consumers, this is what the U.S. economy, U.S. consumers want to see, prices going down on a year-over-year basis. Everything else is disinflation. It's not deflation. Don't mistake it with prices going down. So, if anybody says, oh, prices have been going down, no, prices have not been going down. The rate of increase of those prices have been going down. There's a huge difference and has a very different meaning. So prices have been going down for energy, right? That is oil prices, the prices that you pay for gas at the pump. And that, of course, is sitting at negative 6.8%. Now, if you come over to things like shelter, they're coming down, right? In other words, the rate of increase is coming down. Again, I want to be very clear. Rents are not coming down. Shelter prices are not coming down. It is the rate of increase of those prices that are coming down from well over 8.1% to now sitting at 4.9, almost 5%. In other words, rents are still up. Shelter prices are still up by a lot less compared to where they were at the peak of this inflation cycle back in March 23. So they're still up, but closer to 4.95%. And since shelter makes up for a third of inflation, obviously that's keeping headline higher and even core higher, because when you look at core strips out the food and energy. So it strips out the energy component, which has really been the main reason why there's been so much disinflation for headline. So if you strip out for energy, what's really keeping core higher is shelter prices. So if you look at all items as food and energy, you can see that we're sitting at well over 3.3%. That's exactly where it ended up being, kind of stabilizing at that level. So, if you look at these numbers, 3.3%, still well above the Fed's target of 2%. Fed's preferred measure is always going to be PCE, a little bit of a different calculation. That's the personal consumption expenditure compared to the consumer price indexes. But nonetheless, 3.3% is still higher than the Fed's target. And does that warrant a rate cut? I'll let you be the judge. In my opinion, I think the first rate cut should have been a 25 and then another 25, and then to close it out, maybe another 25. But if the Federal Reserve does another 25 in December, that's going to be a full 100 basis points worth of cuts in a span of 4 months. They started in September, then they did another one in November, and now they're going to be doing one in December. So that's a full 1 percentage point rate cut in a span of 4 months, which in my opinion is going to lead to some more quantitative easing that could lead to inflation reaccelerating back up, especially when you consider the next 4 years is going to be filled with deficits, overspending, excessive money supply because of Trump's many tax incentives, many tax cuts, as well as a pro-business, pro-economy, administration. Now that is not bad. That is certainly not bad from a short to medium perspective. I think I'm very bullish. In fact, I'm doubling down in the U.S. economy, stocks and real estate combined. I think it's going to be very good for the overall business landscape. Money-wise, like there's going to be a lot of opportunities to make a lot of money in stocks and real estate, but what's going to be the end game? What's going to be the result of all of this? Now, of course, some people have been saying that, now that Doge is set up, the Department of Government Efficiency from Elon Musk, they're going to be spending a lot less money. They're going to be more efficient. They're going to streamline the entire process. Sure, there's definitely an argument to be made there, but bottom line is fiscal discipline is very important in the US. It's now more important than ever before because we are now getting up to some insane levels when it comes to the national debt and the level of deficits, which is also pushing the yields to some very crazy levels. And if you take a look at the equity risk premiums are nothing but the premium that you're getting for taking on additional risk over and above the risk-free rate. So that's how you kind of look at it from a risk-reward standpoint, right? What's the opportunity cost of you holding on to a treasury bond, right? And that number is diminishing significantly. Why? Because of two things. Number one, yields are pushing up, right? So yields are pushing up. So the rate that equities need to give us is also going up, because why would you want to invest in equities in the first place when you can get a very nice 4.5-5% in bonds? The reason why you want to invest in equities in the first place is because you can get a higher rate of return. Now, since prices have gone up significantly, now you've got an earnings yield on the S&P 500, which is now lower than what it was before. So equity risk premium is nothing but the premium that you get, which is the rate of return that you can expect to make over and above the return that you would get from let's say a treasury bond. And that number has been diminishing. So in other words, the attractiveness of equities is diminishing over time as both equity prices go up and bond yields go up. So if that continues to happen eventually, sooner or later, what's going to happen, it's going to put an impact on the equities as well. Right? There's going to be a flight to quality. There's going to be a flight to safety, as we've talked about this before. We've seen this rotation happen over and over again. And that is something that I really want you to be prepared for, because this is a cycle that happens every few months, every few quarters. And we see that, kind of money rotate in and out of these different parts of the market, different sectors. And eventually, what ends up happening is the market gives us great buying opportunities. The money vest index comes down, volatility spikes again, and we've got ourselves a very nice market where we can actually deploy capital into. So it's always been about preparation and being ready. Being ready has been very important for us and our community. And that's why we've got that liquidity framework that you can refer to and kind of decide, okay, where do I really want to be from a cash exposure standpoint. Now, coming over to Max 7 here, Google, Nvidia, Meta were the three stocks that were selling off. Everything else was green. Tesla here up 0.5%. Netflix, Amazon was the big leader, up over 2.5%. When it comes to individual sectors, we got the bond market, once again, underperforming significantly. Technology was down. Healthcare was down. Utilities actually has been performing very poorly, as you'll see in the next slide. And QQQs were slightly down. Everything else was up, with discretionaries leading the way, thanks to Amazon, and real estate energy also pushing higher. And this right here is the sector performance on a year-to-date basis. Now we've got comm services actually leading the way, up over 34%. Just second to financials here, 32.7% increase. And then we've got industrial. And take a look at utilities. Utilities used to be a sector that was leading this market higher. And now it's only up 24%, as technology is also up 24%. So that differential has pretty much been next to nothing now. I mean, at one point, this differential was over 10%. Utilities were outperforming tech by over 10%. And now that has come down to pretty much next to nothing, right? So that just tells us about the market that we're in. We're in a very risk-on market. This is a market that is not interested in defensive utilities or staples, and it really wants to double down into technology, financials because of higher yields, staples, discretionary, and even Bitcoin, which is now just going to crazy levels at over $93,000. However, as a meme, Bitcoin plunging to prices not seen since this morning. That's how crazy it's gotten. It's now trading at well over $90,000. So this right here is the price here, just coming down to under $90, $90,000. And of course, the all-time high sits well over $93,000. So congratulations to everyone, to all the Bitcoin traders and investors. Our personal ETF, my favorite, is IBIT, which also has been doing really well. If you take a look at since August 5th, this ETF has now more than increased by over 81%. I think it was up like a little bit over 100% at its peak of well over $53, almost up 90%. So not 100% quite yet, but a very, very strong increase, as you can see, on the back of course, Bitcoin prices going up to new all-time highs. So congratulations, everyone. Bitcoin's obviously been on just this massive run-up. However, I'd also be very careful considering how overbought it's now starting to become from a technical standpoint. And volatility here continues to slide lower. We're now down to 14 as the MoneyVest index also comes down to, if you come over to the MoneyVest index here, we're trading at 3.85. And look, this is where majority of the time the MoneyVest index has spent. It's actually spent in optimistic zone between 3.5 and 4. And I broke all of this down in my video, in the MoneyVest index video. So if you come over to this, if you scroll down a little bit, you'll see, of course, we got the options portfolio update for week 11. And this right here is the video that I'm referring to. The MoneyVest index buy signal, when it's triggered, how it's triggered, and why it's triggered. Like a lot of the data, a lot of the analysis, entire, bell curve and statistical analysis, and going over a lot of data points to better help you understand why we use it. And guess what? 40% of the times in the last 17 plus years, I think that we've done the analysis for, MoneyVest index has traded between 3.5 and 4. That's the optimistic zone. So chances are most of the times you're going to find it in an optimistic zone because market tends to be very, very strong and near all-time highs. And that's why it trades between 3.5 and 4. The moment it gets above 4 and closer to 4.5 is the moment that I'm like super, super cautious and my cash level starts to increase because of how expensive, technically overbought, and euphoric that market can be. And the same holds true on the way down. If the MoneyVest index is below 3.5 or 3, or better yet, below 2.5 or 2, that's a pure buy signal for me personally to deploy a lot of capital and be very, very aggressive from a risk reward standpoint. Now, one more thing I want to mention is that if you take a look at the CAPE ratio, right, that number on the S&P 500 is now sitting at 38. That's the highest for the third time in history. And it's above 98% of all historical valuations for the market. So this is certainly a very expensive market, so to speak, right? So we talked about this in our previous updates. Fundamentally expensive, technically overbought. MoneyVest index wise, it's not in the euphoric or greed zone yet. So sentiment and momentum still relatively strong, but fundamentals and technicals are certainly by no means cheap or oversold. So that's exactly why we need to be very careful here, especially if you're a new investor or trader. If you're just someone who's just getting started, be extremely careful. Understand that the markets are trading at an expensive level with very overbought stocks, pretty much everything trading near all-time highs. You can kind of see that on the MoneyVest market snapshot. You can see that pretty much everything is in a dip, which is well within 2 to 3% of their all-time highs. Most magnificent stocks also are either near all-time highs, in a dip, or in a very small pullback. So all in all, this is a very strong market fueled by a lot of, I would assume, to be a post-Trump election winning rally, fueled by a lot of new money kind of entering this market and a lot of greed that's also fueling this market's higher. So caution is very much needed in this type of market environment as volatility also crumbles to less than just about 15, under 15, just a little bit over 14 right now. So crude oil prices a little bit over $68 per barrel. Yields continue to spike. We're now sitting at 4.45%, so up another 45 basis points, putting a lot of pressure on TLT and TMF. Coming over to some individual indices, S&P 500 is still up almost 5% on the month. And if you come over to seasonality, you'll notice that we are 75% probability that we're going to be higher in the month of November. As we're kind of halfway through the month of November, markets are still very, very strong. And I think this month we're going to close out green, considering S&P's very up almost 5%, and the Nasdaq also pushing up a little bit over 6.2%. So far this month has been absolutely incredible. So I'm pretty confident that we're going to close out the month green. It's just a question of by how much and what's going to be December like. And December also, seasonality wise, is also the second best month since 2000. 70% probability that we're going to see December also higher. Actually, it's the third or the fourth best performing month after April and May. April and May has also been very strong, but November by far has been the strongest at over 2% average return by the S&P and a 75% probability that we're going to see green. So that being said, if you come over to the technicals here, we continue to consolidate a little bit over the last 3 days. You can see that we're just trading sideways here. Support level is going to be 18.6, near overbought levels for the RSI, the MACD, and of course the L3 banker oscillator. So just be very careful here. And S&P 500 also consolidating sideways for the most part. 6,000 got tagged. That's the all-time high. Support level 58.75 down to 57.66. Coming over to Apple, and Apple here also consolidating sideways, so not really going anywhere. 221 is going to be that support, 236 is going to be that resistance. A lot of consolidation sideways for Apple. Amazon hitting a new all-time high, so congratulations to everyone. We've been talking about Amazon on the channel for, gosh, I don't even know, like for a very, very long time. And, I mentioned that Amazon, I think, is just getting started with its profit engine. I mean, that's a growth company that is just getting started with profitability, and I think that's got a huge runway ahead of itself moving forward. And support level is going to step at 200 down to 195, and Amazon now sitting at $2.2 trillion in market cap. And I could see Amazon easily becoming a $3 trillion market cap company eventually. And if I were to guess it, like 12 to 18 months, Amazon could be a $3 trillion company. Coming over to Tesla here. So Tesla consolidating sideways, not really going anywhere, although it is holding up these gains very well. I mean, usually we've seen, in the past, like when when Tesla goes up, parabolically, within days, it kind of gives us a knee-jerk reaction to the downside. This was an 8% sell-off here. You can see, like in the past when it's gone up so well, another 3 to 4% sell-off here, consistently selling off every single day. You can kind of see that over here going up again, down 4.7, and of course post earnings down 9%. So I'm kind of surprised and at the same time very pleased to see that Tesla's holding up these levels really well. And support level is going to stay put here inside this green rectangle, as I've discussed before, at $270 up to $315 for Tesla. Coming over to NVIDIA, a lot of consolidation sideways, and resistance is going to stay put at 149, 150, down to as low as 144. And of course, we got a 136 support to also watch for NVIDIA here. Advanced Micro Devices continues to sell off down another 3% at the moment, trading inside this green rectangle, which in my opinion is still a support. We're going to be watching the next level, more specific level closer to 133, 134 for Advanced Micro Devices. PayPal, on the other hand, continues to move higher, up another 1%. So coming up to its resistance here at $88, $89. So that right there is going to be a level to keep in mind. Support level at $81 for PayPal. In fact, PayPal has actually done a lot better recently, right? So since October 23, the stock's up like 72% in the last 1 year. Absolutely incredible gains. Support level at $81 for PayPal. Talking about Visa, and Visa here also kind of flirting around the all-time highs. Got a huge gap to fill on the downside. Support level is going to step at $291 for Visa as well. Coming over to a few other companies like Microsoft, Meta, and Google. So coming over to Meta here. Consolidating sideways, resistance is going to stay put at $602, support level at $580 down to $540. Google here also getting rejected at that resistance that we talked about at $183, support level at $175. Microsoft here also consolidating, resistance is going to stay put at $432, support level in the low 400s. And then finally Netflix here also trading near all-time highs yet again, continues to move higher. I mean, this is just insanity how much it's been pushing up. RSI is now at an extreme of 77 with the MACD, L3 banker oscillator, everything moving higher really, really well. Coming over to a few other names, I'm sure you're not going to like this, but Enphase actually ended up closing green for a change, finally finding some support here at $58, $59. Resistance is going to stay put at $73. Very, very oversold right now for Enphase. And finally, if you come over to Costco, also consolidating sideways, support level at $919, $920 for Costco as well. Although it is a little bit more on the overbought side, so I wouldn't be surprised to see a bit of a pullback, maybe a breakdown below $919 to potentially retest down lows of $867. So that's all for today. Hope you all enjoy this update and market update video. So make sure that you drop a like and subscribe to the channel. Again, link's going to be down below if you want to join. Of course, be a part of our MoneyVest community. 2 free months if you decide to pay annually and save 16%. Link's going to be down below. And as always, happy investing. I'll see you all in the next video.